I don't want to say corrupt, so let's just say stupid. Let's just say dumb. Like they do dumb stuff. Are you kind of saying like, do you think they're going to cut rates, or do you think that they're going to maintain them with where they're at, given the current situation?
So that goes back to what you were saying about GDP, because what's really happening is they do need to cut rates. The argument right now is that they do not need to cut rates because we have a strong economy. But the reason that we have a strong economy, and your listeners can go to govflation.com to track these real numbers with us. We do that over there. The problem is that when you look at nominal GDP, you have to deflate that to get real GDP. So what the goal of deflating GDP is to take away the inflationary price increases. Yeah, so there you can see the official government. So see, according to the government, if you CPI is 2.9, so if you lend them money, you're getting a real return of 2.42%. You should lend us money because the rate of interest at 5% is higher than the CPI. So you're getting a positive rate of return. And by the way, when you deduct that from GDP is positive. And but if you go down and you look at the Govflation headlines, which just go back to the 1982 government equation for CPI. So it's not a proprietary equation like Trueflation. It's just going back to the previous pre-substitution based CPI. CPI is almost 11%. So when you take 11% and subtract it from 5%, real rates are negative. And that's what we were talking about before. You have the government is in red because they're understating it, right? But the real rate is in green. It's flip-flopped on GDP. And GDP, you can go back up to the boxes. I think it would be easier to understand when you compare the two boxes. See, Govflation GDP is negative. Government GDP is positive. Why? Well, because they are subtracting a lower inflation rate, because that's the goal. The goal of getting from nominal GDP to real GDP is removing the price increases. When you remove inflationary price increases, now you have real economic growth. That's why they call it real GDP, because we want to see the real economic growth when you take away price increases. So when they say price increases are 3%, but they're really 11%, well, then when you reduce nominal GDP to real GDP by too small of an inflation rate, GDP is positive. So the economy is strong, right? That's what you're hearing a lot right now. The economy is strong. Everything is good. They don't need to lower rates. You can see there actually in the second quarter of 2022, which should be no surprise to anybody, because when they started raising rates in March, the goal of raising rates was to create demand destruction. Right? Because they said that inflation is coming from the economy. Therefore, we must punish the economy. We must raise rates on the economy. We must destroy demand from the economy if we want to get these prices down. So what did they do? They fought the economy instead of the currency, and they crushed the economy, and GDP went negative. We've had negative GDP for 9 consecutive quarters. Your listeners should know that the textbooks say 2 consecutive quarters of negative GDP is a recession. But most people don't know what a depression is. A depression is 3 years or 12 consecutive quarters of negative GDP. Well, we've had negative GDP now for 9 consecutive quarters. We are only 3 more quarters away of negative GDP from being in a textbook depression. That's how successful the interest rate hiking cycle was. Matter of fact, it was so successful, it would have brought down the entire banking system if they didn't have the Bank Term Funding Program. It was a very successful interest rate hiking campaign. They brought them even higher than I thought they could get them to. But they've destroyed the economy. That's the price we paid.
One thought on that inflation chart there is, because we know that you tell me, they've changed that CPI metric multiple times, not just since 1980 to now, right? It's interesting in that chart, they get further and further and further apart, which is telling us a lot. I mean, it's what we're having an entire conversation about here. We're told that this is what reality is, yet we feel something completely different. And that's why we're sitting here having this conversation now.
Yeah, and just to throw it in, I mean, so Jerome Powell's looking at the same shit. I mean, like, he knows. He's not probably as dumb as everybody thinks. He understands. So like I understand now after you're explaining it, okay, need to lower interest rates because the economy is bad. Inflation is looming. I mean, it's like, they did a good job. There is somewhat some truth, I guess, to like what do they try to call it? Like a slow death or whatever. soft landing, slow death. I don't know. Whatever you want to pick. I'm going to choose slow death for this conversation. They're kind of like we're so far down the line, right? That it's like we do need an alternative solution, because even though they did a good job, I mean, probably needed to raise rates even higher in order to get the kind of depression, or they needed to let the banks fail, which we just don't do anymore, in order to create the kind of recession that would actually at least give the middle class a chance to buy back into this country. I mean, like, we don't have a chance right now unless you're buying Bitcoin. So that's not financial advice again, but I'd probably save in Bitcoin. It's the only chance that you have to actually buy back into this country, because in the scenario you just laid out, okay, let's lower rates. What's that real inflation number going to get back up to, you think?
The U.S. Treasury has lost the ability to raise interest rates and create demand from smart lenders, because it doesn't matter which way they go. Griff, if they raise the interest rates higher, you said they should have raised the rates higher. No, because the higher they raise the rate, I'll tell you why. All of us listened. When they raised the interest rates, we slowed down our borrowing. We slowed down our spending. The government did not. Government deficits continue to increase. The national interest expense for government debt has gone from not even being a top 20 expense to now being the number 2 expense in the entire U.S. budget. It's larger than military. It's larger than medical. Only Social Security is a larger cost than our interest. So the higher that interest rate goes, the more inflation there's going to be, because the larger the deficit is going to become. True. And then if they lower the interest rates, what's amazing is and this is where it comes back to this word salad. They get to change the definitions of everything. It really, man, it really pisses me off that they get to do that and get away with it, because, inflation is a monetary phenomenon. So when they lower interest rates, inflation is not going to kick back up, because you know what's going to happen? The net interest expense is going to drop. But what's going to happen is we're going to have economic demand, because all of the people that sold their assets and moved their bank deposits into money market funds and into U.S. treasuries to get the yield, they're no longer going to be incentivized to keep their money there. They're going to sell. And this is what Warren Buffett is doing. A lot of people are confused. Why is Warren Buffett buying treasuries right now, like with a negative carry? That doesn't make any sense, because he's not investing in treasuries. He's trading them. It's common sense. It's 100% chance that they lower interest rates. So when they do, it's the opposite of what happened to the banks. The banks bought at low interest rates. They went up, price went down. They're buying at high interest rates. They're going to get artificially lowered. That's going to create a capital gain. He doesn't have to hold those for 20 and 30 years. He's going to sell them as soon as he gets his capital gain, and then take the profit and reinvest it back into the stock market. So we're going to see economic demand pushing up price. Now I do want to lay this out for your listeners so that the light bulb goes off between the definition of supply and demand and inflation. Because when you have demand from the economy, that pushes up market prices. Now, the government will tell you that's inflation, but that is not inflation. Inflation is from the devaluation of the currency, from creating more currency units that lower the purchasing power of all other existing units. But what's interesting is economic demand passes through on price. Inflation passes through on cost and price. So when you have inflation, the producer's cost of production is going up, and that forces the producer to pass that cost onto the consumer, which forces the market price up. There's no increase in profitability. Matter of fact, sometimes they don't even pass that cost on, and they take a lot of those companies listen to it's transitory. So they didn't raise their prices, because when you raise prices, you push demand away. Higher prices means lower demand. So they didn't want to lose customers, so they kept prices the same, thinking that it was transitory when it wasn't, and their margins got crushed. So you have to push that cost through the margin. But when you have economic demand, it might push up the cost a little bit, but it's not a one-to-one. Inflation pushes up cost to price one-to-one, or else your profit margin shrinks. Economic demand pushes up the market price, but your cost doesn't change. So your profitability increases. And that's a really important thing for people to understand. So it doesn't matter if they lower rates or if they raise rates, whether we get economic demand or more monetary, or I should say currency inflation, no matter which way this goes, prices are going up. And that's why it's so important for people to realize it.